Good afternoon, everyone, and welcome to the Pension and Trust Committee for the City of Franklin. We'll begin with a call to order. We'll do this with a roll call vote. Ms. Carter, are you here? Mr. Bull, are you here?
I'm here.
Mayor Moore, are you here?
Present.
Mr. Townsend, are you here?
Yes.
Mr. McGee, are you here? Mr. McDaniel, are you here?
Present.
And the chair is present. Let that show the ones that are present and the ones that are not. A second item on the
Chairman.
agenda is approval of minutes of August the 23rd, 2021. If everyone's had a chance to read those, if there's any corrections, deletions, we'll entertain those now. There's a correction and a deletion.
Mr. Chairman, if we could go back to item number 1, we do have, Ms. Carter is with us.
Okay.
We're going to formally introduce her here in just a moment, but Ms. Carter is with us today.
All right. Hello there. All right, let's go to item 2 then. We'll continue with the minutes. Any corrections or deletions? If not, I'll entertain a motion to approve. Motion to approve.
Second.
All in favor, better do a roll call vote again, right? Ms. Carter, how do you vote on the minutes?
I approve.
And Mr. Bull, how do you vote?
I approve.
And the mayor, how do you vote?
Yes.
Mr. Townsend, how do you vote?
Approve.
Mr. McKee, how do you vote? Mr. McDaniel, how do you vote?
Approve.
And the chair votes yes on the approval. Let's go to item 3, is the introduction of employee representative Suzanne Carter, which was probably in reverse of some of what we've been doing.
Yes, so thank you. Good afternoon. So we completed our employee pension voting process in September of 2021 due to a vacancy of the retirement for Jeff Rowe. So we had 174 employees vote either in person or via email, and Suzanne Carter was the winner. So Suzanne has been with the city since December of 2015. She is currently with the city's Parks Department and is their Parks and Rec superintendent. And she has a public sector background. Before she came to the city, she has a bachelor's in business administration and a master's in public administration. So welcome, Suzanne.
Welcome. Let's go then to item 4, which is the investment report for 9/30/2021. Do you have Barry up?
Barry, our investment advisor, has not joined us yet. If we could go on through the agenda, and then if for some reason he doesn't make it, you may be stuck with me at the end of
Is
this
the
meeting.
advisor?
So,
Okay. Well,
But
then let's go to item 5, and that's the consideration of resolution 2021-174 to amend the investment assumption plan rate, of the closed pension plan. Christine, you're up again.
thank you, and I'm going to have assistance from Kevin Sullivan, our actuary with Finley. But to begin with, in the packet for this meeting, I included a letter that's dated November the 9th, 2021. It's addressed to myself and the City of Franklin, and it's on State of Tennessee Treasury Department letterhead. And this is an official notification that the city received that the State of Tennessee, the Tennessee Consolidated Retirement System Board, has reduced the investment rate assumption on the state plan. They reduced that by 50 basis points, 0.5%, all at one time. They went from 7.25% down to 6.75%. And with this committee, and certainly both of our employee representatives haven't got to hear several years' worth of advisement from our staff and advisors that this discussion had been happening on the state level for some time to reduce that discount, that investment assumption rate. It impacts us here at the City of Franklin in 2 ways, because our closed single employer plan, while it's a City of Franklin single employer plan that we make our own rules on, even in that case, the state makes a lot of rules that we must follow. And there's actually a state law that says that plans such as our closed plan, we can only be 50 basis points or 0.5% higher than the state rate. That they, for example, they really just don't want us to make investment assumptions that are significantly higher in the future than what the state TCRS board has adopted. And so what this letter is advising us is not only did they change that rate, we are currently in compliance with the state, so there's no issue right now that we're not in compliance. However, it does give us that notification that we are no longer, we had been on a plan to be down at 7% in 2022. Our Board of Mayor and Aldermen had approved a 10 basis point reduction over 5 years to get us down to 7%. So we are certainly in compliance, but we're now going to be 25 basis points higher than the state rate. And so what when we received this official notification, we contacted our actuary, and we're going to let them talk just a little bit about some math. But we as staff, and we talked with both the city administrator and the law department, we are recommending that this committee consider a resolution which would go back to our full Board of Mayor and Aldermen and ask to continue reducing that interest rate assumption by 10 basis points a year over another 5-year period. Because our plan was that we were going to be down at 7% and see where we were with the state, and they have now moved. So we are recommending to continue to reduce that by 10 basis points a year. That you see that resolution 2021-174 that's in your packet, and of course the first page of the resolution is all the whereases and what for. But on the back of that, the second page actually shows you the history of the interest rate assumption for the City of Franklin's closed plan. And back in 2002, that interest rate assumption was 8%, and you see how we have declined over time, that this staff proposal will, by 2027, have us at 6.5%, which we are recommending that you consider. While it may sound very conceptual, the interest rate assumption for a pension plan, it does have real cost associated with that. It has actually a cash implication to future budgets, and that is something that we do want you to be aware of, and that when the interest rate assumption goes down, if there's no change in market conditions and external factors, the employer contribution will increase in the future. And so I would like Kevin Sullivan, our actuary, who his firm also serves as actuary to the state of Tennessee's plan, so they do monitor those meetings at the state level. They know kind of what's in their thought process, as well as he can talk about the projection. It's a projection of costs to our own plan, to our own City of Franklin future budgets, but he's able to talk from that perspective as well.
So the tolerance today is 50 basis points from the state.
The state law says that we can be no more than 50 basis points above the state rate, and we, in 2022, will be 25 basis
And
points
so they're
above
moving
it.
to 675?
Yes,
Okay.
sir.
Okay, yeah, all right. So we would still, it was, if we land at 7 and keep going, we're not gonna ever be out of that, we shouldn't be out of that band unless they drop remarkably again, I guess.
Our staff proposal is to slowly get ourselves down to 6.5%, which we don't know where the state exactly will be in 5 years, but what their practice has been is they have made large changes at one time rather than small incremental reductions. And that's a decision that the state funding, the TCRS has done in the past. But because of the cost implications of making large changes all at one time, for the City of Franklin, declining a little bit each year has been something that we could financially incorporate.
So have they, have they moved in 50 basis points increments before? That's, on 6.5%, 50 beeps is a pretty aggressive move, I would think. It is. Yeah.
Yes.
And they have, I believe, in the past moved in 50 basis points increments. They were at 8% back virtually the same time City of Franklin was, and moved to 7.5. I do believe there was one 25 basis point move in there to 7.25, and then down to 6.75. The timing here, I think, is very important because in the 5 years it will take the City of Franklin plan to get down to 6.5%. TCRS will have reconsidered their rate again, and it's possible they'll move down 25 basis points or 50 basis points, but in either event, you'd still be within that tolerance if you continue down the path to 6.5 by 2027. Well, I'll go ahead and send around a single page, sending the same version in both directions. So let's see, this is something very similar to what you've seen in the past where we're just providing information on the funded status of the City of Franklin plan and some of the key drivers of that. So, and as Christine said, we've been on a historical decline of 10 basis points per year. So in looking at this information, when we started at January 1, 2020, we were still at 7.2%. So if we compare really the third and fourth columns, that's the impact of moving from 7.2 to 7.1, so that 10 basis point decline. And the contribution went from $4.9 million to $5.16 million, so about a $220,000 increase for that 10 basis points. Now, when we put this together, we looked at what if you did just at one time go down to 6.75, and assuming you had done that at the beginning of this year, that makes an increase of a little over $800,000 and that again would be a 35 basis point move, but that's not what we're contemplating here. But it does give you the ability to kind of look and see what the impact of 10 basis points would do. For 35 basis points at a little over $800,000, you still get to about that same number of $220,000 to $235,000 per 10 basis points. Now, it's important to remember this is the assumed rate of return. And there's two key components to the contribution. There's the value of new benefits being earned, and then there's the amortization of unfunded liability. If we continue to earn the same thing we would otherwise, yes, we have this $230,000 increase, but we also, if we're still earning what we would have otherwise, and we're declining that assumed return by 10 basis points, this means that our loss is going to be smaller or our gains are going to be bigger, which means when we amortize the unfunded, we're going to have some pickup there, some reduction in the contribution from that. There's a formula we like to say for pension plans. The benefits are ultimately paid for from one of two places, contributions and investment return. And to the extent you're assuming less in investment return, you have to put more in contribution. However, if over time you're getting the same investment return, the contribution is going to drop to meet that, to where the benefits equal the contributions plus investment return. So this really, it has the impact of reducing risk because you're putting a little more money in now, and if we do have some big losses later on, they're going to be, the losses we have to amortize are going to be smaller, so there's going to be less of a negative impact from negative market returns if we have those down the road. So yes, it does increase the contributions now, but it reduces our risk down the road. And again, ultimately, if we earn the exact same thing we would have otherwise, this assumption change doesn't really matter long term. We're just paying more now and less later.
So remind me again, so this is the closed plan, right? So it's a finite amount of money, correct?
Yes.
And so we know who the census is, right?
Right.
So as that gets older, though, wouldn't that help that we wouldn't have to put as much money in because you've got mortality and we've had better returns, though, right? So all that's impacted into how you got to the $800,000 number?
Correct,
Okay.
correct. So all of that's built in. We know the ages of the population. We know either what their benefits are going to be or projected benefits will be. And so one big unknown is the investment return. So this is just our assumption for what those future investment return amounts will be. We make similar assumptions for things like for mortality, future pay increases, rates of termination, things like that. And all of these gains and losses are factored in over time, just as if salary increases are higher than expected, that's going to increase the contribution slightly. If mortality is higher than expected, that's going to drop the contribution slightly. But the big assumption does over time tend to be this investment return assumption. To the extent we're getting close to it, the contribution is going to be fairly level. If we're missing it, big one way or the other, it's going to move the contribution up or down over time to meet that gap.
Eric, do you have any comments you want to make on this? I mean, related to the other committee that we sometimes go to, it's a significant impact when we start doing our budgeting and our planning from that standpoint. So for the state to drop 50 basis points and for us to be now over where we thought for a long time we would be under is a pretty significant hammer to us then.
Well, it's something we need to respond to, but I would tell you what we've done over the last 4 years has been very manageable. It's fit in our budget, and I think just continuing that for another 5 years makes a lot of sense. It's been something we've been able to accommodate in the budget, and we've continued to move there. And so I like the approach in that it gets us there, and ultimately, in just a few years, we'll be below them. They may reconsider it, and we'll see what they do then, but I feel like it's a good measured way to adjust it and get us not only in line, but ultimately a little bit below their assumption, which is a pretty good place to be.
Any other questions? Any comments? Then, what we will do then, I'll ask for a motion to approve this resolution, and that motion will be to go to the full board. And do you have a time frame for that to go to the board to be voted on?
What we have currently in plans would be to go December 14th to the work session to explain to the full board, let them think on it, and we would go to the
We
full
don't wanna-
board
we
for a
don't
vote
wanna-
in
Yeah,
January.
we don't want to labor them too much through Christmas.
This is not necessarily something that the board has to act on in December, because we already have the next reduction, the final 10 basis points is in place, but it does, while we have this all in our thoughts and minds, if we just keep on going to the full board for work session and then to January for
First meeting in
voting,
January, vote on it, Derek? Okay.
then
All right.
we'll have that in place by the time the actuaries start working on the next report.
Right, because this change would first affect numbers as of 1/1/2023.
Yes.
So you do have a little time here.
Mr. Chairman, I'll make a motion to approve the resolution to move it to the board.
Proper motion, is there a second?
I'll second it.
Okay, let's do a roll call vote. Ms. Carter, how do you vote?
I approve.
Mr. Bull, how do you vote?
Approve.
Mayor Moore, how do you vote?
Yes.
Mr. Townsend, how do you vote?
Yes.
Mr. McDaniel, how do you vote?
Yes.
And the chair votes yes on this. Resolution 2021 passes. Let's go to item 6. If Barry is not available yet, he hasn't checked in with us. Then let's go to item 6. Consideration of Second Amendment to the City of Franklin amended and restated employees pension plan effective as of 1/1/2018. Workers' comp. Sarah, looks like you're up again.
Yes. Yes, thank you. So we are proposing a second amendment to the employees' pension plan, specifically to address the definition for average compensation pertaining to employees that have been injured on the job, addressing either formula, either before 2010, so it's the 3 highest consecutive years, or after 2010 is 5 consecutive years, allowing them, if they've received payment from our third-party administrator, to drop the lowest year, or the year that they've been injured, and go down to the next consecutive year. And I'll let Frank chime in as well, if you have anything to add.
Maybe for the board, the problem that arose was that you had employees that would have a compensation on the workers' comp, which is less than their full comp. And so just because they were injured and had this reduction in their comp, they were then getting penalized, so to speak, on their pension because of being lower because of the injury. So what we did is just merely said in that 5-year period out of 10 years, we would just take out the workers' comp year and substitute the first year that's not a workers' comp year. So there wouldn't be that damage to them. And we've talked to the actuaries to be sure that that wasn't going to have some sort of adverse impact on the plan to do that.
So these are just folks who have had work-related injuries and then received that really short-term disability payment.
Right.
And that is, they're essentially kept whole during that period of time, but it's tax exempt wages and is also by definition excluded from their pension calculation. So this kind of helps rectify that by allowing for the substitution. It also doesn't create a situation where maybe somebody who was hurt on the job has sort of an incentive to stay on a year longer to fix their averaging, or a longer period of time to fix that average. It just seemed like the right thing to do to allow that. And again, if it's a 5-year person, it's just substituting a different 5th year, consecutive year, or the 3-year folks, it's going back to that 4th year to allow them to substitute that in. So we have had a preliminary discussion with the board on it. Board seemed favorable. We talked to them at work session, and this is scheduled for a vote on the 14th of December, but we would like your guidance or recommendation to the board to go with that when they consider it on the 14th.
Right, and just to give a little perspective, so, you know, in the time that I've been at the city, 16 and some odd years, there's one person right now that would benefit from this. So we're very fortunate that we wouldn't have this situation very often, but we wanted to go ahead and get something proposed to this group and to the board to offset that if it arose in the future.
This would go into effect immediately, essentially. And like Sarah said, there's one we know of. There's one that might be out there that might be coming that is similar to this, but it is pretty rare. But it makes a lot of sense when somebody's been impacted in a work-related injury as well.
Move approval, Mr. Chairman.
Any question, okay, proper motion, second.
I'll second it.
Any questions, guys?
The only question I had right now is if somebody had that injury that went from September of one year to March of the next year, they had an extended period of time, would they be allowed to do this twice, essentially, and substitute 2 years if both years? Does this allow that to happen is my question.
I'll look back at the exact wording, but I think it does because it goes back to the first year that's not a workers' comp year. So both of those years would be workers' comp years, right? So you'd go back further till you get to the very first non-workers' comp year. And we used kind of that language to help guide us when we get to those issues. We expected we'd have some issues like that.
Any other questions or comments?
Just one more thing. I think the way it's written too is it gives the option to the employee. Let's say just 1 week of workers' comp, you don't just throw it all out. You can elect to say, no, that year's still fine.
That's right. If the workers' comp year is higher for some reason, then they get to use that year. That's correct.
Then let's do a roll call vote on that. Mr. Carter, how do you vote?
Approve.
Mr. Bull, how do you vote?
Yes.
Mayor Moore, how do you vote?
Yes.
Mr. Townsend, how do you vote?
Yes.
Mr. McDaniel, how do you vote?
Yes.
And the chair votes yes on that. Let's go then to item 7, this update on the Tennessee State Chapter 382 employee request for pension transfer to TCRS. Christine, you're up again.
Well, both Sarah and I may have some comments on this item. We wanted to get back with the committee to follow up at our August meeting. We discussed with the committee a change in state law that it was something that actually, and it's a little bit of a special circumstance that would have to happen for someone to be affected by this state law. But if an employee left the employee of the City of Franklin employee that had been on the closed plan, someone who had been employed here years ago, and then went to work for the state of Tennessee or another local government that was in TCRS, in an open TCRS plan. The state law that was passed said that if the former governmental employer allows for transfer of assets out of their plan into the state plan, that was something that the state would take those assets on behalf of a current employee and do a calculation to consider how much of a transfer of service credit that would be. It was not a year-for-year service credit, but there was a big if in that state law, and it said if the plan that you used to work under allows for transfer of assets. And we asked Mr. Carney and of course our own city attorney, Shauna Billingsley's office, to look at that. And they both agreed that the City of Franklin's closed plan does not allow for transfer of assets out of that plan. And so when we came to this committee, because we had at that point, I believe, two former employees that had asked that were now, I believe one was working for another local government, one was now working for the state of Tennessee, asking to have plan assets transferred. And I also got a confirmation from the director of TCRS that it does require, it does not require that the former employer transfer assets if they're not allowed to do so. The state was not requiring that. And so we gave a staff opinion to this committee that we believe that for the sake of the health of the closed plan, that we keep those assets in trust, that there's a really high barrier to maintaining the trust on a closed pension plan, and transferring assets out would not be in the benefit of the entire plan to do so. And this committee went through this very closely and did make a recommendation to the full board to keep our closed plan and its assets in trust. And so what we did next was we did go to our full board in a work session and explained, and probably not as much detail as this committee heard, but we explained what the state law change was and what the recommendation of the pension committee was. And what's in your packet is the signed resolution 2021-156. The Board of Mayor and Aldermen on October the 12th did approve a resolution confirming the intention to keep that closed plan and the assets held within the trust of that closed plan. So we wanted to follow back with you. I believe, Sarah, the Human Resources Department was waiting to have formal action from the board before contacting former employees. While we did have the opinions that we could not transfer assets out of that plan, this way, it was in a public meeting in which the full Board of Mayor and Aldermen understood the issue before them. So I'll let Sarah discuss kind of if there has been contact with those employees, or if any more employees have made requests.
Yes, so we had two previous employees reach out to us, and they have been contacted via email with a copy of the resolution, and I have not, since all of that, had anybody else reach out to me.
And I did also follow back with TCRS's director and let him know that our board was not going to open up for transfer of assets. Just certainly in case he received a request directly from former employees, he's got that on his radar, what the decision was.
So we discussed this the last time, then we took it to the full board. So now we're being asked to approve Resolution 2021-156? Is that what we're?
I think you're just being informed
being-
that the action has happened. It kind of
Yes.
closes the loop
just on-
on your recommendation last meeting. So
Okay.
I think we're pretty much finished at this point with this.
We are. We just wanted this committee to be aware what the full board had done, and certainly we have two employee representatives. There's always the possibility that a former employee, who may have gone to work for the state, is somebody that still has friends or former coworkers here. So we wanted you to be aware of that decision and that this is what's happened. But there's no formal additional action needed by the committee.
Any questions, comments? Kevin? No. All right, let's go to, I see the long-lost Barry. Let's go back then to,
I'm sorry, I thought I was unmuted, but I wasn't, so
you thought you were unmuted? Let's go back
First
to-
of all, apologize for being late. I had some computer issues, but I am with you now. We ready for the performance report?
Let's go.
And for the sake of everyone on the committee, there's an electronic version, but Barry's office did send hard copies, and he may refer to some pages on this in this document that is in your packet for your reference.
Okay, we ready to go?
Ready?
All right, I thought I heard a partial yes there. It got cut off, so I hope you all can hear me. Can you all hear me okay?
Yes.
Okay. Do you want to I guess you all are looking at the report in one form or another, so it doesn't have to be up on the screen, correct?
It is anyway.
It is on the screen.
Oh, it's on your, okay, all right, that's fine. I can't see it, but that's all right. I've got,
If you refer to a certain page,
Yeah.
one of my colleague, Michael, will be able to assist with that.
all right. Just remember, I'm seeing what you're seeing, but I'm seeing it on my report on my computer. So if things appear off, just let me know that. So let's go to page 4, and I'll be sure we're on the right page. And while we're going to page 4, I'll just tell you, it was kind of a nothing quarter from a return standpoint, although it was very bumpy, as I will describe. But our portfolio did better than most in a kind of a nothing quarter. But there were just a lot of positive signs, I have to say, once again, by the way it performed. So starting on page 4, GDP was up 2% for the quarter. That was less than people had expected around midsummer. It goes through a couple of revisions and a final number. We're not to the final number yet, but it's going to be around that. And it's much down from some of the big numbers that we had before. It still hasn't settled out with the COVID numbers driving it kind of up and down. So it doesn't have quite as much meaning as it usually does. The economy right now, so many things have happened just in the last week or two. It's really hard to say where anything is going. I'll start with COVID. This variant, it's still too early. You know, we're now sort of hyper responding scientifically, and we didn't really have detailed comments about any of these other variants this fast. We've now got detailed comments 3 days after the variant was first detected in South Africa. And so having said that, what we've been told isn't really very educated in one sense, but it looks as though this variant is extremely contagious, extremely successful in basically beating out other variants, but not all that deadly. And if that turns out to be the case, I mean, the issues, of course, are how communicable is it, how dangerous is it, and how responsive is it to vaccines. But if it turns out to be infectious, but not very dangerous, that's a really good combination, because if it beats out other variants of the virus, it means people will get sick, but they won't get hospitalized. And that basically over time sort of solves the COVID problem, at least from a disease standpoint. Politically, goodness knows what will happen. But there is a possibility that this could sort of be the light at the end of the tunnel, kind of the last hurrah. But it's really still too early to know. Based on the anecdotal evidence I've read, people just don't seem to be getting very sick from this virus. It may be because of the populations it's been in. You know, South Africa is an example. On the one hand, the population is young. On the other hand, they have a lot of AIDS people who are immunocompromised. So there's been a lot of debate back and forth. Now, I go through all that detail about COVID because it has a tremendous effect on how we read the economy and what's going on with the economy in the following ways. If COVID causes people not to go out again, it's going to cause the Fed to the Fed is now in the process of withdrawing support from the economy. If this flattens the economic growth, the Fed is going to kind of back off. Inflation is probably going to kind of back off. It'll make the supply chain issues, maybe a little bit easier. And everything, could conceivably get better. On the other hand, if it quickly becomes apparent that the disease is in its last phases, everything could get all revved up. The Fed could continue down the road of becoming increasingly hawkish. It's gotten more hawkish in some very subtle ways in the last couple of months. Inflation could be worse than we're expecting. All of that could cause the market to trade off, more than it already has. So not being an expert in any of these areas, I will just tell you things are in flux right now. The one thing that seems to be going pretty well, corporate earnings seem to be going pretty well. The stock market seems like it kind of wants to continue going up and probably will if all of these other factors, the inflation, the COVID, the responses of the Federal Reserve Board, if those things cease to be as much of a problem as they had been, it looks as though the market wants to go up. It's on the expensive side right now. I've repeated the statistic. It is still true. The market tends to trade, or on the long-term average is 15 times forward earnings. It's now trading at 20 times forward earnings, but it's been as high as 29 times forward earnings in the tech bubble. So it's expensive, but it's not as expensive as it has been. And the multiples actually come down a little bit because earnings have been so great. We've kind of worked our way out of it. So that's kind of where we are right now and where we're going as this year closes out going into next year. So I'm going to pivot from that to talk a little bit about just the third quarter ended September. So let's look at the numbers in the chart in the upper right-hand column. Oh, I do want to point out this one thing in this economic chart, though. You can see these big inflation numbers. Now, these numbers were originally thought to be transitory. The Fed has backed off of the stance that they're transitory right now, and could be, might not be, but that point of view was the dominant point of view. I think it's no longer the dominant point of view. I think it is now recognized that there is a real danger of inflation resurgence. And if you look at industrial capacity, I was just preparing an educational piece for another group, and in that piece, I had forgotten, but 75% is kind of the crossover standpoint. Industrial capacity is how much of the resources in the economy are being used. As that number goes higher and higher, it tends to be inflationary, and we are now in the territory where in the past it has been inflationary. So that's everything on the economy. Now I'm going to pivot and go back to the third quarter. So if you look in this chart in the upper right, you can see the Russell 3000 negative 0.1%. If you go all the way down to the second to last number, the Barclays aggregate was up 0.1%, not much difference. Bonds were up slightly, stocks were down slightly, but they were both close to zero. So that means, number one, there's not going to be much return when the two major asset classes are close to zero. And number two, there's not going to be very much difference between portfolios. Whether or not your portfolio is mostly bonds or mostly stocks doesn't really matter. The couple of things that did tend to skew results in this quarter were really three things. Number one, small cap stocks, Russell 2000, were down a lot, negative 4.4%. Emerging markets downs were down a lot, 8%. If you had a lot of those, you did not so well. And again, growth stocks did better than value stocks. If you look at the chart in the lower left, the quarter there, growth stocks were up 1.2 for large cap stocks, and down negative 0.8 for value stocks. And that was true across all categories except for small cap. Small cap value stocks did a little bit better. But those three things, if you tended to be tilted to growth, if you tended to have more large cap, and if you tended not to have emerging markets, you did a little bit better. The other thing I should also mention, real estate, private real estate, the NCREIF Odyssey, that's in the chart in the upper right, third to last line in that chart. That was the best print they've ever had, the Odyssey has ever had, 6.6%. 6.6% is about what is expected for a year of return in private real estate. So that was hugely beneficial. People that had tilted portfolios away from bonds and toward real estate as a bond substitute did relatively better. Now, with that said, I'm now going to go down to the TCRS portfolio. I think that's what I want to do. No, I want to go first to page I want to put this into context first. So let's go to page 8. Okay, we on page 8? Yes? Nods? Okay. We made 2% in the quarter. The typical pension portfolio was, I think, negative 0.1%. And so this number, this 2% number, this is with one exception, the best portfolio I've seen this quarter. 2% is actually not a bad quarterly return. And to get a return like that, when they're basically, I told you there's no return to be had, there was no return to be had in the basic asset classes. And yet we still managed to make 2%. So how did we do that? Now let's go down to the TCRS portfolio. That is on page 17. The way we were able to make 2% when nobody else really made anything is that our managers beat their benchmarks significantly. Now, we don't have individual managers in here, we have portfolios, but most of these portfolios are internally managed by TCRS with a couple of exceptions. But the areas where they did really well, international developed equity. Now that happens to, I think, be a portfolio of mutual. It's a portfolio of mutual funds. So they're not managing the stocks themselves, but they pick managers to manage them. That had a positive return, 0.9, when the benchmark was negative. The emerging market equity was down 4.9, but emerging market index was down 8. Private equity was plus 14.4. Now, that's a little bit of a cheat in the sense that private equity, the valuations are lagged. And so if the market goes down, it doesn't necessarily go down at the same time. But still, the private equity return in one quarter of 14.4, that's a very good number. And if you look back and compare how they've done, particularly over 5 years in private equity relative to the Cambridge US Private Equity Index, the numbers are really stellar. The real estate was slightly above benchmark. Strategic lending was above benchmark. Domestic fixed income matched the benchmark. There really wasn't anything that did worse than benchmark particularly. So by having all of these individual allocations above benchmark, they were able to make 2% in a quarter where most people didn't make anything. And I'm thinking back when I first talked with them, which at this point's been a while ago, maybe 5 years ago, something like that. And we went through the portfolio in detail and they told me all the things that they were doing. The guy that runs TCRS was explaining, we're not so good here. We're kind of lagging our benchmarks here. This is what we're doing about it. We're trying to fix this up. And he talked about that in one of their domestic quant portfolios, in their private equity portfolio, in their real estate portfolio, in their strategic lending portfolio, all of the things that they were doing to improve their ability to beat these benchmarks. And looking at these numbers, I've kind of come to the conclusion that they have been successful. They have, in fact, created, at least as evidenced in this quarter, the ability to beat these benchmarks. And of course, if you can do that, your asset allocation, and you can always do a little bit better than your asset allocation. Your asset allocation is not too far from the mainstream, which theirs is not. They're actually a little on the conservative side. You are going to win the game long term. And that appears to be what they're doing. So I was really happy with these numbers. I thought they were great. Last thing I'll say, I kind of skipped this in the beginning, but the return patterns have been very, very bumpy. So the first 2 quarters, everything was pretty much up. That continued in July and August, and then September plunged. And September's plunge wiped out the positive numbers in July and August. Then we got into October and up went the market again. October was like a great month, and it looked like portfolios were going to make, 3-4%. And then, down it went about mid-November, and it went back down because of the COVID variant and the problems that I've talked about at the beginning. I don't know how the year is going to end up. And as I said before, I don't know how things are going to play out. There are too many things going on right now to make predictions with any confidence. But what I'm becoming increasingly confident in is the TCRS portfolio is doing well for you guys. Any questions?
Barry, I don't see any.
I see a room of silence. Silence and motionless. People are not even moving. The attorney smiled. I think that's good. Sometimes when attorneys smile, it's good. Sometimes not.
You do sound pleased, Barry, with our report and an otherwise quarter of not a whole lot of good news. Is that a correct summary?
Yeah. My only concern about this portfolio, I have two concerns about this portfolio. Always got to worry about stuff. That's, in a sense, what we're sort of paid to do, is to worry what can go wrong. They do have this long bond portfolio, and a long bond portfolio will not do well in a rising interest rate environment, and that is a concern of mine. However, that long-term bond portfolio helped them during the COVID crash. This portfolio outperformed in the COVID crash. So whether or not that concern ever gets realized or not, it hasn't been a huge negative up until now. And the asset allocation in the portfolio is somewhat conservative, but if they beat these benchmarks, that fixes that problem. So yeah, there's always a give up, there's always a risk, but I am about I'm certainly as happy with these results as really I could be at this point. I mean, you go back and look at, let's go back to page 8. Their rank over 5 years is 30th percentile, and the asset allocation is relatively conservative. So you're beating 70% of the public fund portfolios out there. And you're really taking less risk if you think that risk is short-term volatility. So that's a very good trade-off. So, yep, I'm pretty pleased with these numbers for you guys.
Any other comments or questions, Barry? Christine, you have anything to add to that?
No, sir.
New board member, do you have anything that you'd like to ask? No, sir? No one should pick on the new board member, should they?
Mr. Chair, Mr. Mayor, if I could, let me just ask you guys, how are you all doing with COVID? How are the first responders doing with COVID? What's the vaccination situation? What's the political temperature? That's something that I always ask my boards, because you guys are really my first line source of information.
I can chime in on that. Overall, we're in a pretty good position. We track cases and activity. We are much closer to normal than we were a year ago, that's for sure. We don't know exactly the level of vaccination, but my rough estimate is about 2/3 of our team has probably been fully vaccinated. Don't know about those who've been boosted, but a lot of folks have been, just anecdotally from just talking to folks or hearing them talk. I don't ask that question directly, but people like to tell you. So we are in pretty good shape, but we do keep an eye on it. We have provided extended COVID sick leave really throughout the year. We had a little window where we didn't, and actually the board's going to act on next week on closing that little window, but we've tried to provide a little extra support along the way. to encourage people to isolate if they have any exposure, so that we don't have issues that grow from that. But by and large, knock on wood, we're in pretty good shape operationally, and feel like we're heading in a good direction. We'll see what. One thing we've learned the last 2 years is to never get too confident about what's coming next. So we just continue to adapt and adjust and serve our community, and that's what we're focused on.
Good answer.
Questions or comments? I see our former finance director. Any questions or comments? Russ, can you hear us? Can Russ hear us?
Yes, I can hear. Barry, you sound a lot more confident in the TCRS portfolio than you did 5 years ago. I think Barry thought we were crazy when we started to move in that direction.
Well, I think 5 years ago, we had no evidence as to how it would actually perform. And there were a number of places where their active management was underperforming index funds. And there was this issue of the long-dated bond portfolio. And even 5 years ago, we were looking at a potential rise in interest rates. So there were some things not to like about it. Maybe they just got lucky. I don't think so. And I don't think the outperformance of the benchmarks is luck. Maybe they got lucky with a long-dated bond portfolio, but that's a conservative measure to protect in the case of a downturn. Who could have predicted COVID, but it worked. So, I follow the numbers. And the numbers have been good.
I'm always dubious about things continuing
Well,
forever.
you have to be, but then you have to ask yourself the question. You got to be happy at something, and would you be happier if they had underperformed in the past? I don't think so. So yeah, you have to worry about the future, but give yourselves a moment of pleasure. I think this was the decision of you, the decision of the board, and it's worked out well, and you should be happy with yourselves.
Any concerns, Barry, about potential returns? Before you joined the meeting, there was a discussion about lowering our return on investment assumption for actuarial purposes over a period of 5 years, from the 7% that we're targeting now down to 6.5%. A lot of the prognosticators are assuming that returns over the next 5 to 10 years will not be as glorious as they have been over the last 5. Any thoughts?
Yes. We think that Wall Street tends to systemically cry wolf on this issue, because in the next breath, what the prognosticators or the other people for their firms will tell you is the way that you solve this problem is investing in our extremely high-priced alternative assets, hedge funds, private equity, tactical asset allocation, and various other strategies. So we're a little bit skeptical of that, but it's based on two things. One is Treasury yields tend to predict 10-year returns, and Treasury yields right now are quite low. And that relationship is relatively robust historically. And the other is this high multiple I talked about. If you believe that the long-term multiple of domestic stocks is 15, and it's now 20, then 15 should be your projection. So if you lose from 20 to 15, you're going to have to make up for that in earnings. And if earnings don't do any better than average, the market's not going to perform as well as it had. That's what it's all based on. 7 to 7.25 is the average right now. Many people are lowering their assumptions. It is only prudent to do so if you can afford it. I mean, what's the worst that's going to happen? You won't have to put as much money into the pension fund 5 or 10 years from now. So I absolutely, I wish all of them, some of my clients, I have clients at 6.5%, most are not. Many are talking about lowering it. I think you are prudent to do so. And if you stayed at 7.25, instead of being at or a little ahead of the curve, few years you'd be behind the curve, where people are going, generally speaking.
Thanks, Barry.
I believe, Christine, that's just about what you covered, wasn't it, without Barry's help? Huh? Not the last sentence
You
or
give me
two.
way too much credit,
last
Chairman
sentence or
Barnhill. Way too much.
Any other questions of Barry? If not, let's go to, see, we've already done planned participation. Let's go, I guess are we at adjourned? Number 8, planned participation, update. Sarah, you're up again.
Me again. So I did this for the first time last year and thought it would be interesting to do it again for this year. So this is just a summary of kind of the activity this year, how many retirees we have. One piece of information I'm quite excited about is the defined contribution that started in 2010. So employees that were hired after February 15th of 2010 could be either in the defined benefit plan, which was pension plan, or a defined contribution plan, which was more of like a money market plan. So that is officially over. So the conversion provision allowed employees that chose to be in the defined contribution plan to, after 5 years of service, after they were vested, buy into the pension. So I just notified the December 2016 employees that they had an option to do that. So no more. So I'm very excited. It's difficult to calculate, but so that is officially finished this year. Out of the 2010 conversion or contribution and the defined benefit, 275 employees were hired since then. 164 signed up for the defined benefit plan. 111 of those signed up, of the 275, signed up for the defined contribution, and 7 that were in that plan elected to buy into the defined benefit plan. This year, we have 16 retirees. They started retiring in October, so October, November, and December is usually the higher month. And then the TCRS employees that were hired 1/1 of 17 are eligible after 2 years of service to participate in the city's matching 457 plan. So this year, this calendar year, we've had 65 employees become eligible, and we've had 14 of them enroll. So I just wanted to share some data with you. Do you have any questions?
Eric, do you have a comment on 14 out of 65 or so? On an employee, well, we're matching 14 out of 60-something? Is that, I would have thought that would have been higher, but that's not my concern
I don't know.
necessarily.
So we when I notify them that they're eligible, I go ahead and send them information of enrolling, and I think there is interest, but the fact that they can do it kind of at any time, they kind of just read it and put it to the side. But we have started looping in Trey Sizemore, so whenever an employee is eligible, I make sure they have Trey's information, and Trey has that employee's city email, so he can reach out and answer any questions too.
It really is a nice benefit, and it's just kind of sitting there to take advantage of. So I think what we can do is just continue to make them aware, and we know folks are stretching budgets and that kind of thing, but really it is a great opportunity to enhance their retirement.
Yeah, and we have a
preparation.
monthly newsletter that we send out on the benefit side, so we include it occasionally in that as well.
And what are the percentages again? Up to 2%, 3%?
Up to 2% match.
2%.
And they can modify it at any time.
Anytime.
So
They
they
can
can, it can
fluctuate
go
at
up and
any time.
down
Go
however
to
they want.
1%, they could they drop it and then get back into it
Yes.
a year later or so?
Yes.
It's very flexible.
Any questions or comments on that? Okay. Any other questions of the plan participation update? Any questions of anyone before we adjourn? Christine, yeah, go ahead. You probably have a schedule that
You
like
know
to
me so
present.
well.
I have one
Would you
quick
like
thing
to
too.
Chairman
present?
Barnhill. Thank you. I did want to just looking at calendar year 2022. This committee has been meeting 3 times a year, and in most recent years. There's also been a early summer written report that I've sent out and collected information from everyone who supports this committee. If that general calendar seems to work, I would recommend that our next meeting be on Monday, March the 7th at 1 p.m. For Chairman Barnhill and Mayor Moore, that is a busy week. We have a Budget and Finance Committee on Thursday of that week, and then we also have a board meeting, but you would get a lot of good quality time with your finance staff that week of March 7th, if that's agreeable to you.
Makes me so happy.
Put us all in 1 week.
So, and certainly if we can't get a quorum, then that would be another issue. But otherwise, Monday, March the 7th at 1 p.m.
We'll set that up. If
And I'll
anybody
send
that cannot
notifications
make it,
out.
We will make whatever arrangements we need to make.
And then if we stay with our schedule, we will also meet in person in August and December and work with you on finding those dates as we get closer.
All right, now, you know what the mayor's favorite motion is? Eric's favorite motion too?
Can I make a real quick note, just
Yes,
for,
you
some of you know about this, some of you don't, but it relates to something Kevin said earlier about wage adjustments having an impact on our responsibility in terms of pension funding. We have proposed an additional cost of living adjustment effective the first pay in January. We've seen pretty significant inflationary impacts. We've seen a higher than normal vacancy rate. We've been fortunate on the revenue side that we've seen some really strong sales tax performance. And so have talked to the board about this and talked to the Budget and Finance Committee meeting last week about this. But we're proposing an additional 2.5% cost of living adjustment across the board for our team members. We are making a corresponding adjustment to the pay grades of 5% to go with that. That in and of itself does not drive pay up unless someone drops out of the bottom of that pay grade, and then we bring them up to the new minimum. So I just wanted to let the committee know, those of you who may not have seen that is moving forward. The board will vote on that next Tuesday, but that has been recommended, and that's, I think, an important element for us in terms of taking care of our people, but also maintaining a good competitive position in the labor market. It's tough, and we're seeing unemployment in Franklin is at 2% right now. So it is a competitive environment for us to work in.
Did you get that adjustment?
He's been informed of that.
If there are no other comments or questions to come before the board, I'll entertain a motion to adjourn.
Can I ask one more question before you?
Yes.
How hard is it to recruit people? Police, fire, and general workers. Really tough environment, tough, but no different from what it has been in the past, or is it getting easier?
I'd say it's a bit different, especially most notably for police. We still we do well, comes to fire, and just there's a lot of jobs open right now, so people have a lot to select from. So yes, it's difficult.
And we're not alone. We see the same thing with other employers when you look at folks with CDL, licenses, that's a significant, highly competitive environment. Just different. We're seeing it more widespread in different areas of employment than we were even just 6 months or a year ago. So that's what we're trying to get ahead of and position ourselves so that we can retain the folks we have and be really competitive in attracting folks. But it is definitely tougher, no doubt.
And we see that, one, in the number of people that apply for certain positions, but also we have to move quicker than we've ever moved, because now if you list a position, you set up an interview, if you don't do that quickly enough, people will call you back and say, I'm not going to show up tomorrow, I've got a job. So we've never had it to this extent until now. So yeah, it's very difficult.
Mayor?
Move we adjourn with one caveat. Merry Christmas and Happy New Year.
All right. Is there a second?
I'll second that.
All in favor indicate by saying aye. Aye. Any opposed? We are adjourned.